why knowing more keeps making you less. Right, let me show you something before I explain a single thing. This one go trade banked a clean 3-1, and I found it in under 20 minutes on a bear chart, running the exact same routine I go through every single morning. No 12 indicators. No 6 screens. No sitting glued to the charts from open to close. And here's the part nobody wants to hear. The reason most traders never get consistent isn't that they know too little. It's that they know too much. Every new indicator, every new strategy, every clever little tweak I bolted on over the years, almost every time, my results got worse, not better. The day it finally clicked was the day I binned about 90% of it and traded one repeatable pattern. The same setup, the same checklist, the same execution every day. It felt almost too simple to work. But stick with me, because by the end of this video, you'll be able to run that exact 5-step checklist yourself. And I'll walk you through the live gold example where every box lit up at once. The promise, what you can actually do after this. So here's the deal for the next 20 minutes. First, I'll show you why piling on knowledge quietly wrecks most accounts. Then I'll give you the whole routine in order. How I map location before I even think about an entry. How I filter the news in 90 seconds. The one signal that tells me a move is exhausted. And the 2 bits of confirmation I wait for before I click. Then the entry mechanics. The maths that lets you win less than half your trades and still come out ahead. And finally, how you grow this from a tiny starting stake without blowing up. Keep an eye out later. I'll freeze on the exact candle that got me into that gold short so you can see precisely what I was looking at in real time. Why more knowledge made me a worse trader. Why more knowledge made me a worse trader. Let's be honest about the trap first, because you're probably standing in it right now. Trading feels like it should be hard. We're wired to believe that a market this big, with this much money sloshing about, must need something complicated to beat. So we go hunting. A new indicator this week, a new candlestick pattern the next, a fresh strategy off someone's channel the week after, and every one of them feels like progress. It isn't. The traders I've watched struggle the longest are almost always the ones with the busiest charts and the fattest notebooks, hopping from setup to setup, convinced the next thing they learn is the missing piece. The missing piece was never another indicator. It was subtraction. The turning point for me was giving up on trying to catch everything the market does and instead choosing one clean, repeatable moneymaker and running it to death. Same location, same trigger, same risk. I stopped caring about the 50 other moves I could have caught, and for the first time, my equity curve stopped looking like a heart rate monitor. Simplicity isn't a compromise here, it's the edge. A rules-based routine kills decision fatigue. It kills the emotional pull to chase, and it kills the self-sabotage that comes from making it up as you go. Step 1. Location before entries. Map the higher time frame. So here's the routine, in order. Every morning I open one chart, and I do the least glamorous thing in trading first. I mark location. Notice I said location, not entry. Most people open the chart already itching to click. I don't touch a 1-minute chart until I know where price is on the bigger picture. For gold Xauusd, my main instrument, I start on the 4-hour. I'm looking for the zones price has reacted to before, where sellers stepped in and knocked it back, where buyers absorbed the drop and lifted it. Those repeated reactions are your resistance and support zones. And note, the word zones, not lines. The market doesn't respect a single thin line. It respects an area. Now here's why this matters more than usual right now, and it's a live example you can pull up yourself. Gold went absolutely vertical into late January 2026 and printed an all-time high up around the $5,600 region on the 29th. Then it did what parabolic moves always eventually do. It snapped back hard, shed a big chunk of that rally, and by early July it's been grinding sideways, roughly in the 4,000 to 4,200 area. That context is your bias. When a market is chopping sideways in a range, the highest probability assumption is that it keeps doing that until proven otherwise. So as price pushes up into the top of that range, into resistance, I'm leaning toward a fade, a reversal, not a breakout. I treat the market as most likely to carry on doing what it's been doing, and I put the odds at roughly 80% that the current behavior continues. That single assumption stops you fighting the chart. Practically, I draw a small handful of things and no more. The obvious high of the range and the obvious low. The overnight high and low, because London and New York love to hunt those. And if there's a clean sloping line the swings keep respecting, I'll add a trend line, an upper resistance trend line on a rising wedge, say. That's it, 4 or 5 marks. This map does one job. It tells me where to expect a reaction. So when price sprints into that zone, I'm not surprised I'm ready. If you draw 20 levels, none of them mean anything. Draw the few that price has actually paid for. Step 2, the 90-second news filter. Before I look for a single entry, I check the calendar, and it takes about 90 seconds. I use a free economic calendar, filter it to the currency I care about, and I'm only asking one question. Is there high-impact news due today that can move gold? And when? That's it. In this market, that means the big US data jobs, inflation, anything Fed-related, plus anything the central bank chair says on the wires, and the geopolitics that have been jerking gold around for months. Take last week as the perfect example. US jobs came in soft. Markets slashed their bets on the next rate move, and gold ripped over 2% in a session. If you're short into a number like that without knowing it's coming, you're not trading, you're gambling. Knowing the schedule doesn't mean you trade the news. It means you're never ambushed by it. Step 3, the exhaustion signal, the unhealthy move. Now the fun part. Price has run into one of my zones great, but a level touching isn't a reason to trade. Strong trends smash through levels all the time. So I wait for the market to tell me the move is running out of fuel, and I have one simple tell for that. An exhaustion move, or what I call an unhealthy move. Picture it. Instead of climbing in orderly steps, price suddenly lurches one big, greedy candle, far bigger than everything around it. That imbalance leaves a gap, a pocket where price moved so fast it skipped over fair value. On a chart, it shows up as a fair value gap. And the thing about a move that violent is that it's usually unsustainable. The market tends to come back and hand most of that candle straight back. This is my catalyst. When price pokes into resistance and does it with one of these ugly, overextended shoves, I get very interested because it flags a clean snapback. One honest warning. Though an exhaustion move on its own does not mean the trend is dead. Plenty of times price fills the gap, catches its breath, and carries on trending. I'm not betting the whole trend flips. I'm betting there's a high-quality reversal to trade, and I only take it when the next piece lines up. And a quiet note that'll save you money. These setups tend to pay faster on the short side because gold sheds altitude far quicker than it gains it. Fear moves faster than greed. When it goes, it goes. Step 4, confirmation. The structure shift plus failed retest. Here's where most people jump the gun and where I used to hand my money away. When I want a reversal, I'm effectively calling the end of an uptrend and the start of a downtrend, and that is genuinely hard, so I refuse to guess it. I wait for the market to prove it to me. And the proof is written in the structure. An uptrend is just higher highs and higher lows, stacked. The moment that changes the first lower low, then a lower high, the character of the market has shifted. That's my third box, but I still don't click. I want one more thing. I want price to try to continue up and fail. That failed continuation is the whole game. After structure breaks, the market will usually throw one more push higher. It traps the last buyers who think the uptrend's still on. If that push stalls and gets slammed back down by a big rejection candle, that's my green light. Think about what just happened. Buyers tried, buyers failed, and they're now trapped above me. That's exactly who fuels the move down as they bail. So my fourth box is a failed retest right under a lower high, capped by an obvious rejection candle. When I've got the zone, the exhaustion, the structure shift, and the failed retest 4 boxes, I'm finally allowed to think about an entry. If any box is missing, I don't trade. And if the whole day never lines up, I close the laptop and go and live my life. No setup, no trade. That discipline is the strategy. Quick one if this is landing. Quick pause if the checklist is starting to click. Do me a favor and tap the like button. It genuinely helps the channel put these breakdowns in front of more traders who are drowning in indicators. Right, back to it. Because now we get to the click and the maths that makes the whole thing work, even when you're wrong more than half the time. Step 5. The entry and the maths that carries you. Let's talk about the actual click, because how you enter matters. I don't sit there with a market order twitching to buy the exact tick. Once I've got my failed retest, I place a sell stop order a touch below that rejection low. A stop order does something a limit order can't here. It only triggers if price actually trades through my level and confirms the breakdown. If price never breaks, I never get filled, and I've risked nothing. If it breaks, I'm in the moment. Momentum agrees with me. On that gold example, price rejected the lower high, rode over, and my order triggered as it sliced back below the minor support, underneath, right as the door opened into that empty pocket, the exhaustion move left behind. Those pockets fill fast because there's very little volume in the way. Now the maths, because this is what lets ordinary people trade for a living. I only take reversals that offer at least 1 to 2, and I love a clean 1 to 3. Risk 1 unit to make 3. Why does that matter so much? Because it means your win rate can be genuinely mediocre and you still make money. At 1 to 3, you only need to be right about 3 times in 10 to break even. Everything above that is profit. Flip it around. If you trade a lousy reward to risk, say risking 100 to make 50, every single loss now costs you 2 wins to repair, and that is brutal on your head as much as your account. I've lived on the wrong side of that maths, and I'm never going back. Put the numbers in your favor and let a 30 to 40% win rate quietly grow the account. Managing the trade without giving it all back. Getting in is half the job. Not giving the profit back is the other half. My stop goes just above that failed retest, the level that would prove me wrong. And my first target is roughly 2 times that risk, usually the range low or the overnight low sitting underneath. If I'm honest, this is where beginners should keep it boring. Set a fixed target at 2 or 3 times your risk and let it hit. Managing a fast trade live, by feel, is a skill that takes time. Don't start there. On the gold short, my first soft target was the prior lows. The moment price got moving, I trailed my stop down behind each closing candle, because on a clean break, every 1-minute candle can be worth a chunk, and I refuse to watch a 3-hour winner turn into break even. There's a subtle shift here that matters more than any rule. Don't only think about your reward to risk. Think about where you are in the move. As price drove into the more major support and the fall itself started to look overextended to the downside, I tightened right up. Because the same exhaustion logic that got me in short now warned me a bounce could be coming the other way. Around 3R, I'll happily bank a chunk. If it's still printing lower candles with force, I'll let a runner breathe. 2 questions run the whole exit. Is the reward still worth the risk from here? And has this move started to look exhausted itself? When the answer flips, I'm out. No hero trades. Scaling from a tiny stake the same way. Let's talk about growing this. Because the honest version is less sexy than the adverts and far more likely to keep you in the game. You do not need a big account to trade this. Start on a demo always when you're learning a platform or a new setup and prove to yourself you can run the checklist for a few weeks without deviating. Only when the routine is boring and repeatable do you go live, and you go live small. The number that matters isn't your position size, it's your risk per trade. Keep it to 1 to 2% of the account, full stop. That single rule is what lets you survive a losing streak, and you will have losing streaks even with a good system. Scaling then becomes almost boring, which is the point. As the account grows and your execution stays clean, you increase your position size in small, deliberate steps, not because you're feeling brave, but because 1 to 2% of a bigger balance is simply a larger number. The setup never changes. The checklist never changes. The routine still takes 45 to 60 minutes around the session that suits your time zone for a UK trader. That's the London Open and the New York overlap, which is where gold does most of its damage anyway. You can run this alongside a full-time job. What grows is the account, not the complexity. Please hear this clearly though. This is a skill you build, not a lottery ticket. There's no guaranteed number. Results vary. And anyone promising you certainty is selling you something. The exact numbers on that gold short. Let me put real numbers on that gold trade, so it isn't just theory. Price pushed up into my resistance zone in the upper half of the range, through the exhaustion candle, then broke structure with a lower low and gave me a failed retest right under the lower high. I placed a sell stop a few pips below the rejection low. Entry filled around the break. My stop went just above the retest high. Call it a 30 pip risk on the setup. First target was the range low, sitting roughly 60 pips below, so 2R. And the runner went for the overnight low beyond that, which is where the 3R came from. Same maths. Whatever the account size. If I'm risking 1%, that trade returns 3%. If the stop had hit, I'd have lost one and moved on. No drama, no revenge. Next setup. Same checklist, different pair, GBP USD. And to prove this isn't a gold-only trick, run the identical checklist on GBP USD around the London Open, perfect for a UK trader. Because that's when cable actually moves. Say sterling rallies into an obvious overnight high that also lines up with a session resistance zone. Box 1, location, tick. It gets there with one greedy candle that gaps away from the pack box 2, exhaustion, tick. Then it prints a lower low, rolls a lower high, and the pushback up fails on a fat rejection candle boxes 3 and 4, tick, tick. Sell stop below the rejection, stop above it, target the prior session low for 2R. Nothing about the process changes. The pair changes, the levels change, the time of day changes, the 5 boxes do not. That's the whole point of a repeatable system. You carry it, not 100 separate setups. The 2 mistakes that quietly kill this system. Even with a clean checklist, 2 habits will bleed you, and I've done both. The first is overtrading, forcing a setup on a day that never offered one. Your brain hates a blank day. It whispers that surely there's money out there you're missing. There is, and it's not yours to take. If the 4 boxes aren't there, sitting on your hands is the trade. The second is meddling with your stop in the wrong direction, nudging it wider because you feel the reversal is still coming. The instant you widen a stop to avoid being wrong, you've abandoned the plan and turned a defined risk trade into an open-ended one. Move stops to protect profit, never to postpone a loss. Practice this week the 3-0 setup drill. Here's a drill you can actually do this week, and it's the fastest way I know to trust a system. Open the gold or cable chart, scroll back, and hand count 30 examples of the full 4-box sequence: a zone, an exhaustion candle, a structure shift, a failed retest. Mark where you'd have entered, where the stop sits, and where 2R and 3R land. Don't trade a penny yet, just log the outcome of all 30. What you're doing is proving to your own eyes that a 30 to 40% hit rate with these payoffs comes out ahead, so that when you're live and you take 3 losers in a row, you don't panic and rebuild the whole strategy. Conviction doesn't come from a guru telling you it works. It comes from you watching it work 30 times with your own hand. One last habit that ties it all together: keep a one-line journal. After every trade, win, lose, or the days you correctly sat out, write a single sentence. Did all 4 boxes show up? Yes or no? Did I follow my exit plan? Yes or no? That's it. Within a month, you'll spot your real leak. And I promise you, it won't be your entries. It'll be the days you forced a trade that wasn't there, or the stop you widened when you should have taken the loss. You can't fix what you don't measure, and one honest line a day measures the only thing that matters. Did I run my own process, or did I improvise? Trade the process, log the process, protect the process. Everything else is noise. The 5 boxes, one more time. So let's lock it in. 1. Location before entries map the few zones price has actually paid for on the higher time frame, and let the range give you your bias. 2. The 90-second news check, so you're never ambushed. 3. Wait for an exhaustion move into your zone, that overextended candle that leaves a gap. 4. Demand a structure shift and a failed retest before you even think about clicking. 5. Enter on a stop order. Risk 1 to make 2 or 3. Protect the profit and size at 1 to 2%. Miss a box, skip the trade. That's the entire edge, not more knowledge, just the discipline to do the same simple thing, well, every day before you go. If you got value from this, subscribe and turn on the bell. The next breakdown drops every week, and I'll be taking one clean setup at a time and pulling it apart the same way. Drop a comment with the pair you want me to map next. Gold's my home turf, but I'm happy to run the exact checklist on GBP USD or the indices too. Go and mark your zones tonight. Run the checklist on demo tomorrow, and let the boring, repeatable version of trading do its quiet work. And the important bit, none of this is financial advice. Trading carries real risk. You can lose money, so manage your risk at 1 to 2% per trade. You open your chart, 50 candles in the last 10 minutes. Price up, price down, up again. You don't know if you're early, late, or just plain wrong. Here's the truth nobody tells beginners. You don't need 50 candles. You don't need 10 indicators. You don't need to watch the screen all day. You need one candle. One 4-hour candle, fully closed. That's it. That single close can tell you the direction the market actually wants to go, not what it's pretending to do in the next 60 seconds. In this video, I'm going to show you exactly how to read that one candle, how to use it to find your bias, your entry zone, your stop loss, and your target, step by step with real examples. No hype, no guaranteed profits. Just a simple way to stop guessing. Hey, welcome back. If you're new here, this channel is for people who are just starting out in trading and want to actually understand what they're doing, not just copy signals from a Telegram group and hope. Today we're talking about one specific tool, the 4-hour candle close. I want to be upfront with you. This is not a magic strategy that prints money every day. There is no such thing, and anyone who tells you otherwise is selling you something. What this is a simple, repeatable way to filter out the noise. It helps you decide, should I even be looking to buy or sell right now? And once you know that, your entries get cleaner, your stop losses make more sense, and you stop fighting the market. By the end of this video, you'll know exactly how to look at one H4 candle and pull 3 pieces of information out of it: the bias, the zone, and the trigger you're waiting for. Here's the problem almost every beginner runs into. You open your charts and you default to a small time frame, 1 minute, 5 minutes, maybe 15. Why? Because it feels exciting. Things are moving. You feel like you're doing something. But here's what's actually happening on that small time frame. You're watching noise, random little pushes up and down that don't mean anything on their own. A 5-minute candle going green doesn't tell you the market's direction. So what do beginners do? They react to every little wiggle. Price ticks up, they buy. Price ticks down, 2 minutes later they panic and close. Or worse, they flip and sell. By the end of the session, they've taken 8 trades, paid spread and commission 8 times, and they still don't know if the market was actually bullish or bearish that day. The fix isn't a secret indicator. The fix is zooming out. And the cleanest way to zoom out, without overcomplicating things, is the 4-hour chart. Let me describe a trade that probably sounds familiar. You're watching the 5-minute chart. Price breaks above a small high. You jump in, buy, feeling confident. 3 minutes later, price drops back below your entry. You're now in a losing position. Your heart rate goes up, and you start asking, do I cut it or do I hold and hope? This is the classic beginner mistake, trading a breakout on a small time frame with no idea what the bigger picture is doing. That breakout you saw on the 5-minute chart might be happening right in the middle of a 4-hour candle that's actually printing a strong rejection in the opposite direction. It's like trying to guess the weather for the whole day by looking out the window for 3 seconds. The fix is, never make your directional decision buy or sell based on a time frame that small. That decision belongs on a bigger, calmer time frame. That's where the 4-hour close comes in. So what exactly is an H4 candle close? Let's break it down simply. A 4-hour candle represents everything that happened in the market over a 4-hour window. It has an open, a close, a high, and a low. The most extreme prices reached during those 4 hours, shown as wicks. Because there are 24 hours in a day, you get exactly 6 of these candles per day, 6 decisions points instead of hundreds. Here's the part beginners miss. While that candle is still forming, the candle is not finished. It can still change shape completely. If you react to what the candle looks like in the middle of its formation, you're reacting to an unfinished sentence. The close is the moment that candle locks in. That's the moment we care about. Not the middle, not the wick poking out mid-candle. The close. A closed candle represents a finished battle between buyers and sellers over a real chunk of time. 4 full hours. It's not a guess. It's a result. You might be wondering, why 4 hours specifically? Why not 1 hour or daily? The 1-hour chart still has a lot of small noise, news spikes, session opens, random liquidity grabs that get fully reversed within hours. The daily chart is great for big picture context, but it's too slow for someone who actually wants to find entries during the week. By the time that daily candle closes, the move you wanted might already be over. The 4-hour chart sits right in the sweet spot. It's slow enough to filter out random noise, but fast enough that you get a fresh read 6 times a day. It also lines up nicely with how the real market actually moves: the Asian session, the London session, and the New York session each get represented by their own H4 candles. The H4 close gives you a cleaner, more reliable signal than chasing every flicker on a 1-minute chart. That's the whole point. Okay, so you're looking at one H4 candle that just closed. How do you actually read it for bias? Here are the 3 things you check in order. First, where did it close relative to its own range? If the candle closed near the top with a long body and a small upper wick, that's a strong, confident push. If it closed near the bottom with a long upper wick, that's rejection, not strength. Second, where did it close relative to a key level? If price closed above a meaningful resistance level with a strong body, not just barely poking above, that's a real signal. Buyers have taken control of that zone. Third, how does the body compare to recent candles? A candle with a noticeably bigger body than recent candles, an impulse. A candle tells you something changed. Momentum picked up. Put those 3 together. Strong close, in its range, closing beyond a key level, with a bigger than average body, and you have a clean directional close. That single candle is now giving you a bias. Let's make this concrete with an example. Imagine price has been stuck below a resistance level. Let's call it 1.085 on Euro USD. Several H4 candles have tried to push above it and failed, leaving long upper wicks each time. That tells you sellers have been defending that zone. Then, one H4 candle comes along, pushes through 1.085, and closes at 1.089, well above the level, with a strong body and only a tiny wick. Sellers tried to defend, and this time, they couldn't. Your bias just flipped to bullish. The level that used to block price from going up has just been broken with conviction. Old resistance, once broken cleanly, can flip into new support. Your plan becomes, I now have a bullish bias. I'm watching to see if price pulls back to the 1.085 zone. If it holds there instead of breaking back below it, that's my potential entry opportunity. Now let's flip it around with a bearish example, because the logic works exactly the same way in reverse. Say price has been holding above a support zone, 1.07. Buyers keep stepping in there, and every dip toward it gets bought back up, leaving long lower wicks on the H4 candles. Then one H4 candle pushes down through 1.07 and closes at 1.066, well below the level, with a strong red body and barely any wick underneath. That's a clean break. Buyers try to defend and failed. Your bias now leans bearish. That old support, once broken with conviction, becomes a zone to watch for a potential retest from below. Again, this isn't sell the second it closes below. It's, I now have a bearish bias, and I'm watching for price to return to that broken zone and show rejection before I consider an entry. Reading the candle is only half the picture. The other half is knowing where on the chart to pay attention. Here are the 3 types of levels worth marking. 1. Previous day's high and low. A lot of price action tends to react around where the previous day topped out or bottomed out. Mark these every morning. 2. Clear swing highs and lows. Find the obvious turning points, a spot where price clearly reversed direction. If you have to convince yourself a level is significant, it probably isn't. The best levels just jump out at you. 3. Round numbers and session ranges. Levels like 1.1, 1.09, or the high, low of the Asian session box often act as decision points since a lot of orders cluster around them. Key principle: less is more. You want maybe 2 to 4 zones on your chart at any time, not 20. Mark a few zones, then wait patiently for an H4 candle to interact with one of them. Let's put everything together into one simple framework. The 5-step H4 close framework. Step 1. Mark your zones. Before the next H4 candle even closes, mark your 2 to 4 key levels. Do this in advance. not in the heat of the moment. Step 2. Wait for the H4 candle to fully close. This is the hardest step. Literally wait for the countdown timer to hit 0. Step 3. Read the close. 3 checks. Where did it close in its range? Did it close beyond one of your zones? Is the body bigger than recent candles? If yes to all, you have a bias. Step 4. Wait for the retest. Don't chase the breakout candle itself. Be patient and wait for price to pull back toward the broken zone. Step 5. Confirm your entry trigger. Drop to a 1-5-minute or 1-hour chart. Look for a rejection candle or small confirmation that the zone is holding. That's your green light. This framework forces you to wait twice for the close and for the retest. Patience is what filters out 90% of bad trades before they happen. Let's walk through a full, realistic bullish example. The H4 candle closes at 1.089, clearly above our marked resistance at 1.085, with a strong body and small wick. That's our clean bullish close. Bias, bullish. Over the next several hours, price pulls back to 1.0855, hovering just above our old resistance turned support zone around 1.085. This is the retest. We drop to the 1-5-minute chart. Price pokes to 1.0843, then snaps back above 1.085 with a small bullish body. Confirmation. Zone held. Entry. Buy around 1.0852. Stop loss. Around 1.083. 5 below the retest low. Target. Previous swing high at 1.096. Notice the whole trade is built on structure, not on a gut feeling. Every decision entry, stop, target ties back to something visible on the chart. Now the mirror version, bearish this time. Our H4 candle closes at 1.066, clearly below support at 1.07. Strong red body, tiny wick, bias, bearish. Price pulls back up over the next few hours toward 1.0695, just under that broken support, which is now acting as resistance. This is our retest. We drop to the 1-5-minute chart. Price pokes to 1.0708, then gets rejected and closes back below 1.07 with a small bearish body. Confirmation. Entry. Sell around 1.0698. Stop loss. Around 1.0715. Above the retest high. Target. Previous swing low at 1.058. Same logic, same structure, just flip direction. Bias from the close, patience for the retest, confirmation on a smaller time frame, then structure-based stop and target. That's the whole method. Your stop loss has a job: to get you out if the idea that got you in is actually wrong. It should sit at the point where, if price reaches it, your original read on the market is proven incorrect. In our framework, that point is usually just beyond the wick of the retest candle. If price goes back through that point, the zone you thought would hold didn't. A common beginner mistake is placing the stop loss too tight right at your entry, or just a few pips away. Normal market noise will hit a tight stop almost every time, even on trades that would have worked. The opposite mistake is placing your stop loss way too far to avoid getting stopped out, which usually means you're oversized or not being honest about where your idea is invalidated. The fix: let the chart tell you where the stop goes. Beyond the recent wick, beyond the zone, beyond the point that proves you wrong. Just like your stop loss, your target shouldn't be a random number either. The simplest approach: target the next real structure level in the direction of your trade. If you're buying, that's the next visible swing high. If you're selling, it's the next visible swing low. These are realistic places where the market has already shown it's willing to pause or reverse. Once you have your entry, stop loss, and structure-based target, you can calculate your risk-to-reward ratio, how much you stand to gain compared to how much you're risking. In our bullish example, we risked about 17 pips to potentially gain around 70, roughly a 1-to-4 ratio. A beginner tip: you don't have to wait for the absolute final target. Many traders close part of their position at a closer level and let the rest run. That's a personal risk preference, not a rule. Before we wrap up, let's go through the mistakes that trip up almost everyone. Mistake 1. Trading the wick, not the close. If you jump in while the candle is still forming, you're trading a guess. Wait for the close every time. Mistake 2. Chasing the breakout candle itself. Entering right as the big H4 closes, without waiting for a retest, means you're buying at the most expensive point of the move. Mistake 3. Ignoring the bigger picture. If the daily or weekly chart is screaming the opposite direction, an H4 bias against that bigger trend is riskier. H4 works best as one layer, not your only layer. Mistake 4. Treating every H4 close as a trade signal. Not every close is clean. Not every close is at a meaningful zone. If the candle closes in the middle of nowhere with an average body, skip it. Mistake 5. Moving your stop loss after entering. You already decided where your idea is invalidated. Trust the plan you made when you were calm. One last thing before the secret tip. This might be the most important part of the whole video. This method, like any method, will produce losing trades. That's not a flaw. That's just trading. The H4 close framework helps you find higher quality setups and avoid a lot of noise, but it doesn't make you right every single time. How much you risk on each trade matters just as much as how you find your entries. A common conservative approach: risk a small percentage of your account on any single trade, often around 1%, sometimes less for beginners, so that even a string of losses doesn't end your ability to keep trading. This framework's job is to improve the quality of your decisions. Risk management's job is to make sure that even when a good decision still loses, because sometimes it will, you're still standing with your account and confidence intact. Alright, here's the tip. This is the one thing that took most experienced traders way too long to figure out, usually after a string of frustrating losses. The first retest is almost always the cleanest one. The more times price comes back to retest the same zone, the weaker that zone gets. The first time price returns to a broken zone, you're often dealing with fresh interest traders who missed the original move. That's usually where the cleanest, sharpest reaction happens. But if price tests that same zone a second time, and a third time, each visit chips away at it. The orders that were sitting there have already been filled. By the third or fourth retest, what used to be a strong wall is closer to a thin curtain. Practical version: when you see a clean H4 close at a fresh zone, prioritize the first pullback for your entry. If you miss it, and price comes back a second or third time, treat that setup with extra caution, or let it go. There will always be another one. 6 new candles every single day. Let's quickly recap what we covered today. One H4 candle close can give you a real, reliable bias, not by magic, but by reading 3 simple things: where it closed in its range, where it closed relative to a key zone, and how its body compares to recent candles. From there, mark your zones, wait for the close, wait for the retest, confirm entry on a smaller time frame, with stop loss and target tied to real structure. And remember the tip: the first retest is usually your best shot. Don't force the second or third. This isn't about turning you into someone who never loses. It's about giving you a calmer, clearer way to make decisions, so your losses are smaller and more controlled, and your wins are built on something real. If this helped you see your charts differently, hit subscribe and drop a comment letting me know which pair you're going to practice this on first. See you in the next video. The first hour owns your P&L. Here's something nobody tells you when you start trading. The first hour after the London Open is where almost your entire year gets decided. Not the afternoon. Not the overnight. That first violent hour. And most people spend it doing the one thing that guarantees they lose. They see a big candle rip out of the open, they feel that pull in their chest, and they chase it. And that candle, the one that looks like the start of a huge move, was built specifically to take their money. Today, I'm going to show you how to sit on the other side of that trade. The side the banks are on. I call this the opening trap reversal. 3 steps, a bear chart, and about 15 minutes of patience. By the end of this video, you'll be able to spot the trap, confirm it with a number, and time your entry to the exact candle the reversal begins. Stick with me. The confirmation trick in step 2 is the part almost nobody uses. What you're about to learn. Quick roadmap so you know where we're going. Step 1. We mark the opening range, the high and low of the first 15-minute candle. Step 2. We decide whether that candle is an honest move or a trap, and I'll give you a 1-number test for it. Step 3. This is where the money is. We drop to the 5-minute chart and wait for one of 2 signals before we touch the button. I'll use gold Xauusd as our main example, because if you trade the London and New York Opens, gold gives you these traps almost every single day. But this works on GBP/USD, on the indices, on anything with a real session open. Here's a promise for later. Once you see the confirmation candle, I'll show you in step 3, you'll never chase an opening candle again. Why the open is a trap by design. Let's get the why straight, because if you don't believe the why, you'll bottle the trade when it matters. When London opens, orders that have been sitting overnight all fire at once. The big players, banks, funds, need to fill huge positions, and to do that, they need liquidity. They need lots of buyers and sellers on the other side of their orders. So how do you get thousands of retail traders to all place orders at the same second? You show them a big, fast, aggressive candle. Fear of missing out does the rest. Everyone piles in the direction of the move, and that pile of stop losses and market orders is the exact fuel the big money uses to fill the opposite way. The move that pulled everyone in gets reversed. That reversal is our trade. Read that again in your head. The trap only works because everyone chased, which means our entire edge is refusing to chase. We let the crowd throw their money on the table, we let them get flushed, and then we slide in quietly on the turn. That's the whole psychology of this strategy in one sentence. Step 1. Mark the opening range. Step 1 is the easy bit, so don't overthink it. Pull up your chart, gold, cable, whatever you trade, and set it to the 15-minute time frame. When the session opens, we let the very first 15-minute candle open, run, and fully close. We do not buy. We do not sell. We just watch it print. Once that candle closes, grab a rectangle tool and box in its high and its low. That's it. In our gold example, the opening candle tops out at 4,060 and bottoms at 4,036. So we draw a clean box from 4,036 to 4,060. It doesn't need to be perfect to the cent. Get the wick high and the wick low and move on. That box is your opening range, and every decision from here references it. 2 lines to remember from that box. The high 4,060 becomes our target if the trap was to the downside, because price loves to snap back to where it opened. The low 4,036 is the level the big buyers are likely defending. Mark them and leave them alone until the trap is confirmed. Step 2. Confirm the trap with 1 number. Now the important part, and the part almost everyone skips. Not every opening candle is a trap. Sometimes the market genuinely means it and runs all day. So how do we tell the difference between a real trap we can fade and a trend we should leave alone? We measure it. A trap candle is a fast, aggressive, one-direction candle that's simply too big for a 15-minute window. Here's the 1-number test. Put the daily ATR indicator on your chart average true range on the daily time frame. That number tells you, on average, how much this market moves in a whole day. For our gold example, say the daily ATR is about $40. That's your day's budget of movement. Now the rule. If the opening 15-minute candle has already eaten more than 20% of that daily ATR, you're looking at a trap. Let's do the maths. It's easy. 20% of a $40 ATR is $8. Our opening candle ran from 4,036 to 4,060. That's $24 of range in 15 minutes. 24 is way bigger than 8. In fact, it's about 60% of the entire day's expected movement burned in one candle. That's not a trend starting, that's a flush. Trap confirmed. One nuance that took me a long time to appreciate. 20% is only the minimum. The bigger the flush, the cleaner the reversal. When I see an opening candle chew through 70 or 80% of the daily ATR, that's when I lean in hardest, because a move that violent almost has to give some of it back. 20% qualifies, 70% excites me. And for the cable traders watching, the test is identical, you just count in pips. If GBP USD has a daily ATR of about 90 pips, 20% is 18 pips. An opening 15-minute candle bigger than 18 pips is your trap. Same logic, same maths, different instrument. Write a 20% number on your chart every morning before the open, and you'll never have to guess. Now close the loop I opened earlier. Even the confirmed trap is not a trade yet. A trap tells you a reversal is likely not when plenty of these flushes overshoot and run another half hour before they turn. So we never enter just because the candle is big. We wait for the trigger, which is step 3. Step 3, the 2 entry triggers. Step 3 is where the money is actually made, so slow down here. Keep your box on the chart, but drop your time frame from 15 minutes down to 5. Now we're hunting for one of exactly 2 candles. If we don't see one of them, we do not have a trade, full stop. The market has to show us its hand first. The first trigger I call the rejection wick. You'll know it as a pin bar or hammer. It's a candle with a long tail sticking out in the direction of the trap. On a downside trap, that's a long, lower wick. Price stepped lower, got instantly rejected, and closed back up. That wick is the fingerprint of a big buyer stepping in and slamming the door. But, and this is the bit people get wrong, we do not buy the wick itself. The wick is confirmation, not entry. We wait for the very next candle to trade above the high of that wick candle, and we enter the moment it breaks that high. Then our stop goes just below the low of the wick, under the big buyer. If they're really there, that low should not get taken out. One thing on timing. This wick can show up right at the tail end of the opening 15 minutes on that third 5-minute bar. Or it might not appear until 20, 30, even 40 minutes in after a bit of consolidation. That's fine. We are not in a hurry. The signal is valid whenever the market decides to print it. Patience is literally the strategy. The second trigger I call the reversal engulf, a big engulfing candle that eats the previous one in the opposite direction. Here, the entry is slightly different and a bit more aggressive, on purpose. If the price ripped down hard and then a big candle comes back and takes out 50% of that last down candle, I enter right there at the 50% mark, with my stop just beyond the low. Why not wait for the engulf to fully complete? Because on a fast market like gold, waiting for the whole thing to engulf can cost you $3 or $4 of entry. You'd be chasing the reversal the same way the crowd chased the trap. Taking the 50% point keeps your stop tight and your risk small. That's the entire reason for the aggressive fill. One caveat, so you don't force it. This 50% entry is for genuinely large, strong, engulfing candles. If you're looking at 2 tiny, indecisive little candles, they don't count. Wait for a proper one, or for a clean break of the small candle's high instead. Small blocks are noise. We only act on conviction candles. Quick one before the live example. If this is starting to click, if you're realizing why those opening candles kept stopping you out, do me a favor and hit like. It genuinely helps the channel reach more traders who keep getting trapped at the open. And keep watching, because now I want to walk you through the whole thing on one clean gold example, start to finish. So you can see how the 3 steps stack up in real time. Full worked example Xauusd, London Open. Here's the setup. It's just gone 8 in the morning UK time, London's open, and gold fires straight down out of the gate. The first 15-minute candle drops from 4,060 to 4,036, a fat red bar. Step 1, I box it. High, 4,060, low, 4,036. Straight away, I'm interested, because that candle is huge for 15 minutes. Step 2, I confirm. Daily ATR on gold is about $40, so my trap threshold is 8. This candle is $24, 3 times the threshold, roughly 60% of the day's range gone in one bar. Trap confirmed, and a big one. And there's a bonus piece of context. 4,036 lines up with yesterday's breakout level, so there should be real buyers waiting right underneath. 2 reasons to expect a bounce, not 1. Step 3, I drop to the 5-minute and I wait. And there it is, a 5-minute candle stabs down toward 4,033, pokes right into that support and closes back up with a long lower wick. My rejection wick. The big buyer just showed up exactly where I expected. But I don't buy yet. I mark the wicks high and I wait for the next candle to take it out. The next candle pushes up through the wick high and I'm in at 4,041. Stop goes just under the wick at 4,032. That's $9 of risk. My target is the top of the opening range, 4,060. Watch what happens. Price doesn't crawl, it snaps. It runs back up through 4,046, 4,052, and taps 4,060. That's about $19 of reward against 9 of risk, better than 2 to 1, on a move that took 20 minutes. And here's the thing I need you to internalize. That rally back to 4,060 only happened because of the opening trap. No trap, no fuel, no snapback. This isn't a random line on a chart where hoping holds there are real orders and real players behind it. When you're positioned with the big money instead of against it, these are the moves you get. Back-to-back traps and the patience rule. Let me give you a variation that will save you real money. Sometimes you don't get 1 trap candle, you get 2 or 3 in a row, all in the same direction. Beginners see that and assume the strategy is broken. It isn't. Back-to-back traps just mean the flush is deeper. And remember, a deeper flush means a cleaner reversal. The setup is still on. But here's the discipline that separates winners from the people who blow up. On a run like that, you still do not enter until you see a rejection wick or a reversal engulf. Look at this cable example. The market falls and falls and falls with no signal for nearly half an hour. If you'd bought early because it's oversold, you'd have been run over 5 times. The signal is what keeps you out of the falling knife. Eventually, at the bottom, a proper engulfing candle prints and takes back a chunk of the fall. That's your green light. Price bounces hard off the low, but only for the traders who waited for the candle. The lesson in one line. The trap tells you which way. The signal tells you when. You need both, every single time. When not, to take the trade. Before we go further, let me save you from the 2 opens that will wreck this strategy. The first is a high-impact news open. If the session opens straight into something like UK inflation, US non-farm payrolls, or a rate decision, that opening candle isn't a liquidity trap. It's a genuine repricing on real information. Fading that is standing in front of a train. Check the economic calendar every morning. If red news lands in the first 15 minutes, sit this one out. The second bad open is a quiet one. If the first 15-minute candle is small, under that 20% of ATR threshold, there's no trap and no fuel. No flush means no snapback. If it's not a trap, there's no trade. Boring mornings are a filter, not a failure. So your pre-open checklist is 3 quick ticks. 1. Is the calendar clear of red news in the first 15 minutes? 2. Is the opening candle bigger than 20% of the daily ATR? 3. Is there a level nearby yesterday's high, low, or breakout for the reversal to lean on? 3 yeses, and you're hunting. A single no, and you wait for tomorrow. London or New York, which open to trade? People ask me which open is best, and for a UK audience, the honest answer is trade the one you can actually sit in front of. The London Open, around 8 in the morning UK time, is the cleanest for gold and for cable. It's your morning, you're fresh, and the liquidity is enormous. If you've got a day job, the New York Open at 1:30 in the afternoon, UK time gives you a second, equally tradable shot. There's a sweet spot most beginners miss, the overlap. From about 1:30 to 4 in the afternoon UK time, London and New York are both open at once, and that's when the biggest, most reliable traps print on gold. If you can only trade one window all week, that overlap is the one I'd pick. Volume is highest, so the flush is cleanest, and the snapback is fastest. One thing to respect about gold, it moves in dollars fast, so your stop distance can look scary. That's why we size down. A $9 stop on gold might be the same real risk as an 18 pip stop on cable once you adjust your lot size. Never judge risk by how big the number looks. Judge it by the percentage of your account. Always 1 to 2%. Second example, GBP USD New York Open. Let me show you the mirror image, an upside trap on cable, at the New York Open. So you see the strategy works both ways. It's 1:30 UK time. New York comes in, and GBP USD spikes upward. The first 15-minute candle rips from 1.37 to 1.3722, a fast 22 pip push. I box it range high 1.3722, range low 1.37. Confirm the trap. Cable's daily ATR is roughly 90 pips, so 20% is 18. This candle is 22 pips comfortably over the threshold, and it's stabbed straight into yesterday's high, a classic spot for a stop hunt above resistance. So the story writes itself. Retail buyers chasing the breakout, big money selling into them right at an obvious level. This is an upside trap, and I'm now looking to short the reversal down to the 5-minute. A candle pushes up to 1.3725, gets rejected instantly, and closes back down with a long upper wick, an inverted rejection wick, the bearish version. I don't sell the wick. I wait for the next candle to break below the wick's low. It does, and I'm short at 1.3712. Stop just above the wick high, at 1.3727, 15 pips of risk. Target, the bottom of the opening range at 1.37, managing the trade once you're in. Getting in is only half the job. How you manage the trade turns a good entry into a good month. Here's my default. The moment price moves in my favor by roughly the size of my risk, I take partial profit, usually half the position, and slide my stop to break even on the rest. From that second on, the trade cannot lose me money, and I'm holding a free runner toward the opposite side of the range. Where do I take the rest? The opening range boundary is my first, most reliable target, because that's where price naturally wants to return after a flush. If the move is strong and the wider trend agrees, I'll trail behind each new 5-minute swing and let it run past the range. But I never get greedy on the core. Bank the first target, protect the rest, and let a winner breathe. And when do I bail early? If, after my trigger, price closes back below the rejection wick's low or above it on a short, the reason for the trade is gone, and I'm out before my full stop even gets hit. A signal that fails fast is information. The big buyer I was betting on didn't hold. Cutting there keeps my losers smaller than my winners, which is the only maths that matters long term. Price rolls over and slides back through the range to 1.37, and if momentum's strong, it runs well past it, which is exactly why partials matter on trades like this. Same 3 steps, opposite direction, different pair, different session. Once you see the pattern, you see it everywhere. 3 mistakes that quietly kill this setup. Mistake 1. Entering on the wick candle itself instead of waiting for the break. The wick is a hint, not a signal. Enter early and you're just guessing the low. And on a deep flush, the market will happily print a second lower wick and take you out. Always wait for the next candle to confirm by breaking the wick's extreme. That one rule alone will cut your losers dramatically. Mistake 2. Ignoring the level. A trap that reverses off yesterday's high, low, or a round number is far stronger than one that reverses in the middle of nowhere. If your flush ends at a spot the whole market is watching, the reversal has backup. No level nearby? Cut your size or skip it. Context is what turns a coin flip into an edge. Mistake 3. Revenge trading. A missed open. You blinked, the trigger came and went, and now you're chasing 20 minutes into the move at a terrible price. Let it go. This strategy prints almost every session. The money isn't in catching every single one. It's in only taking the clean ones and passing on the rest with a straight face. How to practice this week. Before you risk a penny, do this drill for 5 sessions. Each morning, before the London Open, put the daily ATR on your chart and write the 20% number in the corner. When the first 15-minute candle closes, box it and ask one question. Is this range bigger than that number? If yes, screenshot it and label the trigger candle when it appears wick or engulf. No money, just reps. After 5 mornings, you have a folder of trap setups and you start to feel the rhythm which flushes snap back fast, which ones limp. Then, and only then, take it live with the smallest size your broker allows. Risk 1 to 2% per trade, no more. This edge only compounds if you're still in the game next month. The whole strategy, in 30 seconds. Let's lock it in. 1. When the session opens, let the first 15-minute candle close and box its high and low. 2. Confirm it's a trap. Its range must be 20% of the daily ATR, and the bigger, the better. 3. Drop to the 5-minute and wait for a rejection wick or reversal engulf. Enter on the trigger, stop beyond the wick or low, and target the opposite side of the opening range. And the mindset underneath all of it, your edge, is patience. You are not the trader chasing the big candle. You're the one waiting for the crowd to get flushed so you can take their exit as your entry. Master that one idea, and the open stops being scary and starts being the best hour of your trading day before you go. If you got value from this, subscribe and turn on the bell. The next breakdown drops next week, and I'll show you how I manage these trades once they're running, where I take partial profit, and how I trail the rest. Drop a comment with the pair you trade the open on, and I'll take a look. Now go and mark up tomorrow's London Open. You know exactly what to watch for. Not financial advice. Trading carries risk. Manage your risk. 1 to 2% per trade. Thanks for watching. I'll see you in the next one. Simple is not the same as easy. How can I maximize my profits? This strategy has been the most effective for me. Don't miss out. Every beginner strategy promises the same thing. One indicator, a few rules, easy money. And most fail for the same reason they tell you when to get in and nothing else. No filter for when the market isn't offering the setup. No stop logic. No definition of when the trade is dead. Today, I'm giving you a strategy that fits on a sticky note, plus the missing half. The 2 conditions that cancel the trade before you ever click buy. Here's the whole thing in one breath. One indicator, the 50 EMA. Price has to be on the wrong side of it. Then flip. You wait for a small pullback. You mark one horizontal line, and you enter when price takes that line out. Stop goes on a volatility-based trail. Target is double the risk. That's the strategy. The rest of this video is about the parts nobody teaches when not to take it, how to size it, and how to prove to yourself it works before you risk a penny. Part 1. What the 50 EMA is actually telling you. Before we use it, understand it, because trading a line you don't understand is how people end up superstitious about indicators. An exponential moving average is just the average closing price over a set number of bars, weighted so the most recent bars count for more. 50 periods on a 4-hour chart is roughly the last 8 trading days. So that blue line is a rolling answer to one question. What has this market considered fair value recently? which means the signal isn't the line itself, it's which side of the line price is living on. When price spends 40 bars below the average and then closes above it, something has changed. The sellers who are happy to keep selling into every small rally have stopped. That flip is our trigger to start paying attention. Not to buy, to pay attention. There's a big difference, and it's worth about half your account over a year. One more thing to read off the line before we go further. Its slope. A 50 EMA that's pointing clearly up or clearly down is describing a market with a direction. A 50 EMA that's flat and horizontal, with price crossing it back and forth every few bars, is describing a range, and this strategy is close to useless in a range because you'll get a flip, a pullback, an entry, and then price will simply wander back through everything. If the line is flat, close the chart and go and look at a different pair. And why 50 rather than 20 or 200? A 20 EMA hugs price so tightly that it flips sides constantly, a signal every other day, most of it noise. A 200 EMA is so slow that by the time price closes through it, the move has already run for weeks. 50 sits in the middle, slow enough to filter the daily chop, fast enough that the flip still happens near the start of a move. Test other lengths later, but change one thing at a time. Setting it up takes about 20 seconds. Open your chart, click indicators, search for the exponential moving average, add it, open its settings, and change the length to 50. Leave the source on close. That's your entire screen, a candlestick chart, and one line. No oscillators, no volume profile, nothing else. If you find yourself wanting to add a second indicator to confirm the first one, that's usually a sign you don't trust the plan yet, and the fix for that is testing, not more lines. Part 2. The long setup, step by step. Right, the sequence, 4 steps, and every one of them has to happen in order. If step 3 shows up before step 2, there's no trade, you just wait for the next one. Step 1. Price has been trading below the 50 EMA, not for 2 bars. I want to see a stretch of it, 10 bars or more. So we know we're flipping an actual downtrend rather than reacting to noise around a flat line. Step 2. A candle closes above the 50 EMA. The close is what matters. A wick that pokes above and closes back below is not a flip, it's a failed attempt. And you'd be amazed how many beginners take that as their signal. Body above the line, on the close of the bar. Now the clock starts. Step 3. And this is the part that gives the strategy its edge. You wait for the pullback. Specifically, at least 2 consecutive candles pushing back against a new direction on a long, that's 2 red candles in a row after the flip. Why 2? Because 1 red candle is just a pause. 2 in a row means a genuine counter move started. Buyers took a breath, and the people who bought the very top of the breakout are now underwater and nervous. That's when the good entries appear. The moment you have those 2 candles, draw 1 horizontal line and only 1 across the highest point reached before the pullback began. That's your trigger line. Everything now hangs on it. If price can reclaim that high, the pullback failed and the new uptrend is resuming. If it can't, nothing happens and you keep your money. You've turned a vague feeling about direction into a single, testable yes or no condition, and that is the entire job of a trading plan. Step 4 is the entry, and I want to be strict about it because this is where beginners leak money. You enter when a candle body closes above the trigger line, not when the price touches it, not when the wick pierces it while the candle is still running with 4 minutes left on the clock. A close. If you're on the 4-hour, that means you might wait 3.5 hours after the level gets tagged, and yes, sometimes the trade runs without you. Take that trade-off. It's the cheapest filter in the whole strategy. Part 3. The short setup is the same thing, upside down. Everything works in reverse, and you should trade both directions or you'll spend half the year sitting on your hands. Price has been above the 50 EMA for a decent stretch. A candle closes below it, that's your flip. Then you wait for at least 2 consecutive green candles pushing back up. That's your pullback. Now you draw your horizontal line at the lowest point reached before that bounce started, and you sell when a candle body closes below it. Same structure, same discipline, opposite direction. And a small practical note, shorts on many pairs tend to move faster than longs, so don't be surprised if your target gets hit in half the time. That's not you being clever, that's just how fear moves compared to greed. Part 4. Where the stop and the target actually go. A setup without a stop isn't a strategy, it's a hope. And I don't want you guessing at a round number of pips, because a fixed stop is too tight in a volatile session and far too wide in a quiet one. So we use a volatility-based stop, the chandelier exit. Added from the indicator list, the standard settings, 22 periods, and a multiplier of 3 are fine, and you shouldn't touch them until you've tested 100 trades with them. What it's doing under the hood is simple and worth knowing. It takes the highest high of the last 22 bars and subtracts 3 times the average true range. So, in a market that's swinging around, your stop automatically sits further away. In a quiet market, it tucks in closer. It's placing your stop where the market's own noise level says it should be, rather than where your account balance wishes it could be. Your take profit is mechanical. Measure the distance from your entry down to that stop, and place your target the same distance again above your entry, doubled, 2 to 1. And here's why that number matters more than the strategy itself. With a 2 to 1 payoff, you only need to be right about a third of the time to break even before costs. Read that again. You can be wrong on 2 out of every 3 trades and still not be losing money. That is what a good reward to risk ratio buys you. Room to be wrong. 2 management notes. First, you can trail the stop up along that same chandelier line. As the trade develops, it's designed for exactly that. Just be aware you're then trading a different system with different statistics, so test it separately rather than switching mid-trade because you got nervous. Second, don't move the stop to break even the moment you're slightly green. On this setup, price very often dips back toward the trigger line before it goes, and you'd be scratching trades that were about to work. A worked example, start to finish. Let me run one all the way through with round numbers so the maths is easy to follow. Treat these as illustrative figures rather than a live call. Say we're on the 4-hour chart of a pair that's been sitting under a falling 50 EMA for about 3 weeks. On a Tuesday morning, a candle closes at 1.085, with the EMA sitting at 1.0838. That's a body close above the average, so step 2 is done, and the clock starts. I do nothing yet. Over the next 2 bars, price pushes on to a high of 1.088, then 2 red candles print in a row and drag it back to 1.0855. That's my pullback, confirmed 2 consecutive candles against a direction. So I draw one horizontal line at 1.088, the high before the pullback started, and now I have a single condition to watch. Notice the pullback stayed above the EMA at 1.0841, so nothing is invalidated. If it had closed below that line, I'd have deleted the level and moved on. 2 bars later, a candle closes at 1.0892 above the line. And it's a normal size bar, not triple the others, so neither invalidation fires. That close is my entry. The chandelier stop is reading 1.0836, so my risk is 56 pips. Target goes at double that, 112 pips above entry at 1.1004. Now the important part. I don't ask whether 56 pips feels like a lot. I ask, what position size makes 56 pips equal 1% of my account? And if that comes out at a size I find embarrassing, I take it anyway. And then, the boring bit, nobody films. I leave it alone. Stop and target are in, so watching the 5-minute chart will only tempt me into interfering. However it resolves, it goes in the journal as one data point among the 50 I need before the result means anything. One trade tells you nothing, not a comforting thought when you're down, but the correct one. Part 5. The two things that cancel the trade. This is the part I promised you at the start, and it's the reason this strategy has any chance of working. Everything so far tells you when to enter. These two rules tell you when to walk away from a setup that looks perfect, and walking away from good-looking trades is a much harder skill than finding them. Invalidation 1. The pullback goes too deep and closes back on the wrong side of the 50 EMA. Picture it. You got your flip above the line. You got your two red candles. You drew your trigger line, and you're waiting. But before price can take that line out, it slides back down and closes below the EMA again. That trade is dead. Delete the line. What just happened is that the sellers who were supposed to have given up came straight back in. And a market that can't hold above its own recent average has not flipped. It has bounced. And I want you to notice something about that rule. It doesn't stop you losing money on trades you took. It stops you taking trades at all. That's a completely different kind of filter, and it's worth more than any exit rule you'll ever learn, because the trade you never entered has a maximum loss of 0. Invalidation 2. The breakout candle is enormous. If the candle that closes above your trigger line is 3 or 4 times the size of the recent average candle, do not take that entry. 2 problems with it. 1. The move has already happened. You're buying the top of an explosion, and the next natural thing for price to do is give some of it back. 2. And this is the practical killer. Your stop is now miles away because the candle is huge, so your position size has to shrink to nothing, and the 2-to-1 target sits somewhere the market may never reach. How do you judge whether a candle is oversized without eyeballing it? Quick version. Look at the last 10 candles and ask if this one is obviously more than triple the typical body. If you have to think about it, it isn't. Precise version. Put the ATR indicator on the chart and check whether the candle's range is more than about 3 times the current ATR reading. Most oversized breakouts happen on news, which brings me to the filters I'd add on top. Quick pause. If the invalidation rules alone were worth the click, a like helps this reach other people in their first year of trading. And tell me in the comments which pair you'll test this on. Part 6. The filters I would add before trading this live. 3 additions, and none of them make the strategy more complicated to execute. They just narrow when you're allowed to execute it. First, the economic calendar. If a high-impact release for either currency in the pair lands within an hour of your setup completing, skip it. That's not caution for its own sake. It's because news candles are exactly the oversized bars we just agreed to avoid, and your stop will be run for reasons that have nothing to do with your analysis. Second, a time frame decision, and please make it once rather than every session. The 4-hour chart gives you fewer setups but cleaner ones in a stop distance you can actually live with. The 15-minute gives you far more signals and far more noise, and it demands you're at the screen. If you have a job, trade the 4-hour. Most beginners pick the 15 because more trades feels like more opportunity, and then wonder why their results look random. Third, a limit on how many pairs you watch. Pick 4. Learn how they behave, and ignore everything else. Scanning 30 markets for this pattern will find you 30 setups a week, and you will take the worst of them. Because when you're looking that hard, you'll start bending the rules. The pullback was 1 candle instead of 2. The close was almost above the line. 4 pairs, 1 strategy, every rule met or no trade. And 1 optional 4th filter that I think is worth the extra 30 seconds. Check the daily chart before you take a 4-hour signal. If your 4-hour setup is long and price on the daily is also above its own 50 EMA, you're pushing with a bigger flow and you can take the trade at full size. If the daily is clearly below, you're trading a counter-trend bounce, still tradable, but I'd halve the size and I'd take profit at 1.5 times risk rather than 2, because counter-trend moves run out of road sooner. One thing people forget when they're excited about a 2-to-1 target: Costs are real. On a 50-pip stop, a 2-pip spread quietly eats 4% of your risk before the market has moved. On a 10-pip stop, it eats 20%. That's the hidden argument for the 4-hour over the 15-minute, and why a strategy that looks profitable on paper can bleed out on a low time frame. Part 7. Prove it to yourself before you fund anything. Now, the bit that separates people who make this work from people who watch strategy videos forever. You do not know whether this strategy suits you until you've tested it yourself on the pairs you'll actually trade in the time frame you'll actually use. And I'd rather you trusted your own numbers than mine, because a win rate quoted in a video tells you nothing about how it was measured, which pair, which years, whether spread and swap were included, and whether the losing setups were counted at all. Here's the process, and it takes an evening. Open your chart, scroll back 2 years, and hide the right-hand side of the screen so you can't see the future. Walk forward, bar by bar. Every time all 4 steps complete and neither invalidation fires, log the trade date, pair, entry price, stop, target, and the outcome. Do not log the ones you'd like to have taken. Do not skip the ugly ones. That last sentence is the whole discipline of backtesting in one line. You need a sample, not a highlight reel. 30 trades is the absolute minimum before the numbers mean anything, and I'd push for 50 or more. Below 30, you're mostly measuring luck. A run of 4 winners proves nothing, and so does a run of 4 losers, which is exactly why so many beginners abandon a workable plan in week 2. Then do the only calculation that matters. Multiply your win rate by 2 because winners pay 2R and subtract your loss rate. If that number is above 0 before costs, you have something worth trading small and watching. If it's below 0, the strategy isn't broken. It's just not working on that pair in that time frame, and the fix is to change one variable and test again, not to add 3 indicators and hope. And when you go live small. Whatever position size feels correct, have it for the first 20 trades. You're not trying to earn during that period. You're testing whether you can follow your own rules when actual money is moving, which is a completely different skill from clicking through a backtest. Almost everybody discovers they're a worse rule follower than they thought. Better to find that out at 1/10 of the cost. Part 8. Risk, and the 4 ways people break this strategy. Risk 1 to 2% of the account per trade, and let the stop distance decide the lot size rather than the other way round. If the chandelier stop sits far away on a volatile pair and that forces a tiny position, take the tiny position. The setup does not become safer because you like to earn more from it, and no single trade in a strategy with this many signals is worth pushing on. Now, the 4 ways I see people break it. 1. Entering on the touch instead of the close, because waiting feels like missing out. 2. Taking the setup when the EMA is flat, because a signal appeared and doing nothing feels like wasting the session. 3. Moving the stop when price approaches it. That is not risk management. That is simply choosing to lose more later. 4. Switching strategy after a losing streak of 3, which, given a 2-to-1 payoff, is a completely normal thing to happen and tells you nothing at all. And keep a journal, even a rough one. Date, pair, whether every rule was met, and 1 sentence on what you were feeling when you clicked. Within a month, that last column will tell you more about your results than any indicator ever will, because the pattern that shows up is almost never technical. It's the trades taken on a Friday afternoon, or straight after a loss, or the one where you wrote, rules, mostly met. Mostly met is not met. Recap, and what to do this week. Let's tie together. 1. Price on the wrong side of the 50 EMA for a decent stretch, then a body close through it. 2. At least 2 candles pulling back against the new direction. 3. 1 horizontal line at the extreme before the pullback. 4. Entry on a body, close through that line. 5. Stop at the chandelier exit, Target at double the risk. 6. Cancel it if the pullback closes back through the EMA, or if the breakout candle is triple the size of everything around it. 7. No trades when the EMA is flat or high-impact news is due. Your job this week is small and specific. Pick one pair. Set the chart to 4 hour. Scroll back a year and log 20 setups by hand. Every one that qualifies, including the ones that lost. Then look at your own expectancy number and decide from there, not from a video. Come back and put your result in the comments, win rate and sample size, and I'll tell you honestly whether it's worth taking further. If this was useful, subscribe and turn on the bell. There's a new breakdown every week, and the next one takes this same setup and shows you how to hold the winners longer instead of taking 2R every time, which is where most of the money in trend strategies actually is. Thanks for watching, and I'll see you in the next one. And the important bit, this is education, not financial advice. Trading carries risk, and you can lose money. Nothing here is a recommendation to buy or sell anything. No strategy has a guaranteed win rate, and any past results, mine or anyone else's, do not predict future ones. Manage your risk 1 to 2% per trade, and test everything on demo before it touches real money. Trend lines are often misunderstood, and a lot of people just trade them blindly. This can lead to unnecessary losses. So in this video, we'll cover everything you need to know about trend lines, including spotting, fake breakouts, characteristics of a true breakout, and trading trend continuations. So what is a trend line? A trend line is a diagonal support or resistance level that is drawn by connecting a series of swing highs or swing lows during a trending market. You see, markets will move in a direction of the trend, followed by a retracement as price action develops more in the chart. We will have a few areas of swing highs or lows that we can to connect with each other to create trend lines, this diagonal line that we've connected with the swing. Lows will be our support level. Remember not to just take a trade based on a trend line always. Look for more confluence, like key support levels lining up with your trend lines, or FIB levels. Most people draw trend lines incorrectly, so I'm going to show you how to do it, right? You will need a minimum of 2 significant anchor points that line up and connect. Make sure to pick out the obvious tops and bottoms. These should be swing highs or swing lows with a clean move away in to the opposite direction. Now typically you'll draw the trend line by using the wicks, as these often work best. However, the candle body can work as well in some cases, but try to just stick with one of the two and be consistent. Don't switch it up to fit your bias. So why should we use trend lines? As we mentioned earlier, trend lines can act as an additional level of support or resistance. Trend lines highlight certain areas and offer opportunity that we might not have got if we didn't draw the trend line. Now, keep in mind, you don't just enter a trade again based on a trend line. You need other tools and data to support your decision. The reason why people use trend lines is because it offers signals or hints to potential trend reversals. Whenever a market breaks through a trend line, it can mean one of two things. The first thing is a fake out. It can deviate just above or below a trend line, making people think a breakout is coming. But then it often moves in the opposite direction, trapping those breakout traders. Now, usually when this happens, you can see the candles are still relatively small at the breakout, meaning there's no real intention of breaking out. So, the best thing to do in this situation is to anticipate the fake out and enter once you have confirmation. The second thing is a trend line breakout. Is the difference between the fake out and the breakout is the size of the candles. If you notice large energetic candles breaking through a trend line with new candles continuing the move, then it's likely a breakout for even more confirmation. You can wait for it to create a second break of structure, so wait for the market to break its first swing high, creating a new higher high. Then this new higher high should to be broken once again. This establishes a series of higher highs and higher lows. Enter on the newly created level like an old support, resistance, and ride. That trend to maximize your profits. Now we'll go over a few examples that are going to help you drive this point home. In the first example, we'll cover trendline breakout trade here. You can see an uptrend as indicated by the higher highs and higher lows. At one point, it started to go sideways while also making lower highs. We can connect these highs to create our trend line. Now keep in mind that the prior trend was bullish and the price moving sideways for a long time. We can expect an impulse move in the direction of the trend. So wait for price to break out of the trend line with an impulsive move. Then wait for price to break once again past this high to paint a new higher high. This confirms the bullish momentum, and you can enter on the newly created fair value gap and retest of that high. But what about fake breaks? Here we have two obvious points of swing highs that we can connect with each other as the price action develops. We can see it approach the trend line with a third touch. Now it looks like price is breaking out of the trend line with two up candles closing above the trend. Some of you might all be thinking that this is a valid breakout, but you always have to keep the other side of the trade in mind. Because if you look closely, this move up wasn't actually that energetic or explosive. If we look to the left, we can see this down move with candles double the size of the current move up. We also have equal highs right here, which is an area of liquidity. So with this in mind, you want to wait for price to develop more and show you more information. Be demanding. Here you can see that it did go down from these highs with a bearish engulfing candlestick as price continues down. It breaks the swing low. This confirms that it is a bearish trend. Now we can enter when a new level is created, such as a fair value gap. Enter at the retracement with your stop above the high and target the levels lower. Finally, we'll go over an example of trend continuation with trend lines. Here we can see price coming from a downtrend. At one point, it started to change course and move higher. Then it came back down and filled the inefficiency before retreating back. This gives us two anchor points where we can connect a trend line. Now all we have to do is wait for price to return and touch the trend line area. As price approaches the trend line, we can see that it went slightly below the trend. However, it did not have momentum behind it or energy, which is what we want to look for a true breakout. So as we wait for price action, we can begin to see a bullish, engulfing candlestick paint. You can enter long here or wait for more confirmation as the market moves up. It has created a new higher high. This gives you extra confirmation that it's bullish. So now you could enter here on the retest of this resistance area, which has now turned into our new support level. Stop losses set below and target the levels higher. We have only one more example, and you don't want to miss this because trend lines can be areas of liquidity. In this example, we can see the market is in an uptrend as indicated by the higher highs and higher lows. If we know that the market is bullish, you want to wait for it to reach an area of support before entering a long. In this case, we can see a fair value gap just below these lows. We want to wait for the market to take out liquidity down first before reaching these size, which we can identify as trendline liquidity. Trendline. Traders will have this trend line to act as resistance. This area will likely have liquidity resting, as the traders who are short have their stop losses set just above this trend line. Since we know that the overall trend is bullish, the probabilities of a trend continuation are much higher. So we'll wait for the market to retrace and enter once it reaches the fair value gap, stop losses set below the fair value gap, and take profits set at the fee levels higher. Now that you've added trend lines to your tool belt, go forward and try these out yourself. If you know a trader that might benefit from this video, please share it with them. Don't forget to leave a like and a comment in the video. The trader who read the market's hidden language. What if I told you that the most powerful signals on your chart are the ones most traders never learn to read? Not indicators, not moving averages, not some exotic algorithm written by a quant in a bank basement. Just raw candlestick patterns and the institutional story they tell every single session. I'm talking about patterns that reveal who is actually moving price, where they place their orders, and critically, when they're about to trigger a major move. More than 250 years ago, a Japanese rice trader named Homa Munehisa mapped the psychology of buyers and sellers into a system of visual candles. He reportedly built a fortune equivalent to billions in today's money, not by predicting the future, but by reading what the market was already showing him. What he understood, and what most modern traders still miss, is that candlesticks are not random shapes. They are records of intention. They show you where buying pressure came from, where it failed, where sellers stepped in, and where they ran out of steam. Every candle tells you something. Certain combinations of candles tell you something far more powerful. They reveal the footprints of large institutions. In this video, I'm going to show you 5 specific candlestick patterns that go far beyond the basic textbook stuff. These are patterns that reveal institutional accumulation and distribution, expose deliberate liquidity sweeps, unmask engineered false breakouts, and flag reversals before the retail crowd even begins to notice. Stick with me to the end, because the 5th pattern is one that catches traders out on a near weekly basis, and once you see how it works, you'll never look at it the same way again. Pattern 1. The Silent Army, 3-soldier accumulation signal. The first pattern is one I call the Silent Army 3 consecutive bullish candles that, in the right context, act as institutional fingerprints on the chart. Classical technicians know a version of this as 3 white soldiers, but the name is less important than the understanding behind it. These 3 candles are not just 3 green bars. They are evidence of sustained, organized buying pressure over 3 consecutive sessions. Retail traders do not typically produce this kind of structure. Retail buying is erratic. It spikes, pulls back, spikes again. 3 strong, clean bullish candles in a row almost always have an institutional hand behind them. Here is how to read each candle. The first candle. Buyers are stepping in tentatively at first, testing whether sellers can hold their ground. The body should be solid and meaningful, not a tiny sliver. The second candle. The buying pressure is building. Sellers are attempting to push back, but failing. The second candle opens near the first candle's close, confirming that buyers have maintained control overnight or across the session break. The third candle. Buyers have taken full control. Momentum is accelerating. The third candle tends to be the strongest of the 3. It closes near its high and opens near the second candle's close. Together, these 3 candles tell one coherent story. Institutions are entering. Follow them. Now context is everything. The Silent Army by itself is just 3 green candles. What transforms it into a high probability signal is the surrounding market structure. You are looking for 2 things before the pattern. First, a prior downtrend or a meaningful pullback evidence that the market was oversold or that sellers had been in control. Second, a period of sideways movement, a base, or a consolidation zone, evidence that accumulation has been taking place. The pattern does not need to be textbook perfect. What matters is that 3 consecutive bullish candles appear at a point where the structure suggests buyers are taking over from sellers. On Xauusd gold versus the US dollar on the daily chart, the silent army has appeared repeatedly at key structural turning points. A textbook example: price had been trending lower for several weeks and compressed into a base around the $2,290 level. Sellers stopped making lower lows, the first sign that bearish momentum was fading. Then 3 strong bullish candles formed, each with a solid body and closing near its high. Directly above them sat a clear resistance level. The confirmation signal came when the third candle itself broke cleanly above resistance and closed outside the prior range. Entry at the close of that breakout candle. Stop loss just below the broken resistance level. Target at the next significant resistance. That trade delivered a 1-to-5 risk to reward on the initial setup, and a second silent army formed mid-trend on the continuation, offering an additional 1-to-9 before price showed signs of exhaustion. One more example worth noting. On Ethereum versus the US dollar on the daily chart, the silent army formed right at the point of a range breakout. The market had been moving sideways for an extended period. The 3 bullish candles appeared simultaneously, with the breakout above the top of the range, and crucially, the third candle was the candle that closed outside the range. That is the highest quality version of this setup. Because the breakout is happening while momentum is already at peak, you are not waiting for lagging confirmation. You are entering as the move accelerates. Result: a 1-to-7 on that trade before price pulled back to consolidate again. Pattern 2. The institutional dump. 3 bear distribution breakdown. The institutional dump is the mirror image of the silent army. But instead of institutions accumulating, they are distributing. 3 consecutive bearish candles, each with a solid body, each opening near the prior close, each closing near its low. This pattern reveals a systematic handover of supply from institutional sellers into retail buyers, smart money exiting while retail money enters, before price moves aggressively lower. The setup requires the same contextual awareness as the silent army, but in reverse. Before the pattern, you need an uptrend or a clear range-bound market that has tested a significant resistance level multiple times. Repeated tests of resistance without a breakout is a warning. Buyers are weakening. Then the distribution phase begins. Price moves sideways as institutions quietly sell into retail buying. And then the 3 bearish candles appear. When the third candle breaks below a key support level and closes beneath it, that is your entry. Stop loss goes just above the broken support, which now acts as resistance. Target is the next significant level below. On NZD-USD, on the daily chart, the pair had been trending higher and hit a defined resistance zone around 0.615 3 times without breaking through. Each test saw buying activity dry up faster than the last, a sign of distribution. Then the 3 bearish candles formed, and the third closed below a major support level. Entry at the close, stop above broken support. The result was a 1-to-9 move lower before the next meaningful support held price. The quality of this setup came from the confluence. 3 resistance tests, a clear distribution phase, and the institutional dump providing the timing signal. On GBP-USD daily, the institutional dump, combined with a trendline break, created an even stronger signal. The pair had been trending higher, respecting a clear ascending trendline. A double top formed 2 highs at the same level, with momentum visibly weakening at the second high. That is a structural warning. The trend is running out of energy. Then, the distribution range began. 3 bearish candles formed, and the third candle broke below the ascending trend line and closed beneath it. When the institutional dump and a trendline break coincide, you have 2 independent signals confirming the same message. Buyers have lost control. Entry at the third candle's close, stop above the trend line, target at the next significant support. That trade returned 1 to 7. Quick pause here. If these breakdowns are giving you something useful, a like genuinely helps push the content to more traders. Right, let's get into the next 2 patterns, because these are where the real edge lives. Most traders get frustrated by these setups. Once you understand the mechanics, you'll realize the frustration is the pattern working exactly as intended, just not in the direction you were hoping. Pattern 3. The twin hammer trap. Double liquidity. Sweep. Bullish. Here is a scenario that most traders have lived through at least once, and most have never figured out what actually happened. You spot a hammer candle at a key support level. The wick punches below support, the body closes back above it. Classic liquidity sweep. You buy the close, place a tight stop below the wick, and then the market drops again, takes out your stop, and then rallies without you. You feel robbed. What you experienced was not bad luck. It was the twin hammer trap, and it is a very specific, very deliberate institutional pattern. Here is what is actually happening beneath the surface. After the first hammer, institutions have begun buying, but they need more liquidity to complete their full position. Think of it this way. A large institution cannot enter a multi-million-dollar position in one candle without moving the market significantly against itself. So they use a 2-step process. The first hammer collects some of the available liquidity. Then they allow price to drift back down, triggering the stop losses of everyone who entered on that first hammer. Those stops hundreds or thousands of contracts, depending on the market, are the liquidity the institution needs for the second phase of its entry. The second hammer, with its wick sweeping below the first hammer's low, is the institution completing its position. The professional response to being stopped out on the first hammer is not frustration, it is recognition. When you see the second hammer form with its wick below the first hammer's low, and then close back above the support zone, you have confirmation of the twin hammer trap. That is the actual entry. Stop goes below the second hammer's low. Target is the next resistance level above. The risk to reward on the second trade is often better than the first would have been, because your stop is tighter relative to the size of the move. On AUDJPY Daily, the twin hammer trap appeared at a key support area and launched a strong multi-day rally. On GBPJPY, a similar pattern at the 192 zone delivered over 350 pips before price found the next major resistance. One practical note on how to manage the first trade when this pattern is in play. Some traders use a slightly wider stop on the first hammer, placing it below the prior swing low rather than below the hammer's wick. This occasionally means surviving the second sweep without being stopped out, at the cost of a worse risk to reward on the first trade. More common, and in my view more practical, is to treat the two hammers as a sequential system. Enter the first with a normal stop, except that you may be stopped, and immediately look for the second if it forms. Do not double position on the first hammer in anticipation of a second sweep that is speculation on a pattern forming, not a pattern that has formed. Pattern 4. The bull trap twins. Double liquidity. Sweep. Bearish. Now flip the entire logic. The bull trap twins is the bearish counterpart to the twin hammer trap, and it works on exactly the same principle. Institutions engineering 2 liquidity sweeps before a significant move. But this time, the move is downward. At a key resistance level, a bearish pin bar appears, a candle with a long upper wick. that breaks above resistance and closes back below it. Classic short signal. The eager sellers enter, stops placed above the wick, and then the market drifts higher and forms a second pin bar with a wick that reaches above the first pin bar's high. Stops are hit. The market reverses and drops hard. That is the bull trap twins. The mechanics. The first pin bar sweep collects liquidity from the obvious stop-loss cluster above resistance, the stops of traders who went long into the resistance zone. The second sweep then collects the stops of the sellers who entered on the first pin bar. After 2 rounds of liquidity collection, institutions have the fuel they need to push price aggressively lower. The entry is at the close of the second pin bar, once it has confirmed a close back below the resistance level. Stop goes above the second pin bar's wick. Target is the next significant support below. This is a high-quality setup when it occurs in a broader downtrend or at a resistance that has been tested and rejected 3 or more times. On USD CAD daily, the pair had been trending higher before entering a well-defined range, testing the top of that range 3 times. A strong bearish pin bar then formed the first sweep above resistance. Sellers took the trade, stops above the wick. The market then ground higher 1 more session and formed the second pin bar with its wick punching above the first. Second set of stops hit. The market then dropped immediately and aggressively from that second sweep, delivering over 1-6 on the trade. The lesson: do not give up on the short thesis because the first signal failed. The failure was institutional, and the second pin bar told you exactly when to re-enter. On USD CHF daily, the pair had been in a clear downtrend. Price bounced to a resistance level, the former support that had broken to the downside, now acting as resistance. A bearish pin bar appeared at that level. Classic break and retest with a liquidity sweep. But then a second candle with a long upper wick formed and hit the stops of early sellers. That second wick above the same resistance level, the bull trap twins, was the signal entry at the close. The subsequent drop was decisive and well-sustained, confirming that both sweeps had genuinely collected the liquidity institutions needed. In a strong downtrend, the bull trap twins at a break and retest is one of the cleanest setups available. Pattern 5, the fakie setup, inside bar false breakout. The fifth and final pattern is what price action traders call the fakie setup, and it is, in many ways, the most elegant of the 5. It is built on the inside bar, a candle whose entire high to low range sits within the range of the preceding candle, which we call the mother bar. The mother bar is the frame. Its high becomes a resistance level. Its low becomes a support level. The inside bar represents a period of genuine compression buyers and sellers in near equilibrium, the market coiling before its next significant move. Most traders who are aware of inside bars watch for the breakout. When price pokes above the mother bar's high, breakout traders go long. When price dips below the mother bar's low, breakout traders go short. The fakie setup is what happens when that breakout is a trap. Price breaks one side of the inside bar range, triggering breakout orders and triggering stop losses on the opposite side, and then snaps straight back inside the range. The breakout traders are now holding losing positions. Their stop losses are sitting outside the range they just re-entered. As they scramble to exit, they provide the momentum for the real move in the opposite direction. A bullish fakie. The market breaks below the mother bar's low. Short sellers take the bait and go short. Long trader stops are hit, and then the candle closes back inside the inside bar's range. You enter long at the close of the false break candle. Stop loss goes below the wick of the false break. Target is above the mother bar's high, or the next meaningful resistance level. The bearish version is the exact mirror. False break above the mother bar's high, close back inside, enter